How can you invest in real estate syndications and how do you find them? That's what we're going to cover in this video. So a syndication is the most passive way to invest in real estate. A lot of us know that real estate investing is very lucrative. You can get 10%, 15% or more returns, but a lot of people don't want to do it because they don't want to do all the work. Well, a syndication is how you can invest in real estate without being a landlord and without doing any of the work involved. Basically, a syndication is just a partnership where a group of active investors called general partners do all of the active work involved in real estate, and then the limited partners who are passive investors can invest in these deals passively. All the limited partners do is find a syndicator they trust, pick a deal or fund that they like, send the money, and that's it. They collect distributions and read the reports as they come in. So it can't get any more passive than that. We do have more videos about syndications, so check out the playlist up here and in the description below so you can learn more about syndications and funds. Now that we know what a syndication is, how do you actually find one you can invest in, and how do you find people you can trust with your hard-earned money? After all, rule number 1 from Buffett is don't lose money, and rule number 2 is don't forget rule number 1, right? So we gotta make sure we don't lose our hard-earned money. So in this video, we're gonna go over how to actually find those syndicators and how you can invest with them. If you're new to the channel, I'm Ariane and I retired with investment income at the age of 27, and I made this channel to help good people like you learn how to build true wealth and financial freedom. So how do you actually find these syndicators you can invest with that you can trust? First, we're going to deep dive a little bit into how syndications are structured. So syndications are securities and they fall under the jurisdiction of the Securities and Exchange Commission, or the SEC. The only way to legally offer them is through an exemption under the Regulation D. I won't bore you with too many details with all of the legalese there, but basically there are two types of exemptions that syndicators typically use. These are called a 506B or a 506C. A 506C allows syndicators to publicly advertise their offerings, but can only accept accredited investors. Accredited investors can qualify either by their income or their net worth. So you can be an accredited investor if you either have a gross income exceeding 200K in the last 2 years, if you're single, or if you're married, then your income has to be 300K in the last 2 years, and you still think you're gonna make that much money moving forward. So that's the income piece. The second way to qualify as an accredited investor is by your net worth. So whether you're single or you're married, your net worth has to exceed $1 million, and that has to exclude your primary residence equity, right? So those are the two ways you can qualify as an accredited investor. And only accredited investors can invest in the 506C offerings. Now, the second type is a 506B, meaning that B for buddy is how I remember this. In a 506B, the syndicator has to have a pre-existing relationship with the investor that they're telling about their offering. They can't publicly advertise their offering, but in exchange, they're able to take accredited and non-accredited investors. Now, the non-accredited investors still have to be sophisticated investors, meaning they have sufficient knowledge and expertise in financial matters to weigh the value and risk of an investment. I usually remember the two offerings this way. B for buddy, so 506Bs can only take investors that they have a pre-existing relationship with, and 506C, they can only take accredited investors, but they don't need to have a relationship. 506Bs are the majority of the offerings in the US. Over 90% of these types of offerings are 506Bs. Which brings us back to the main reason you're watching this video. How do you actually get into these passive real estate deals called syndications? Well, because most of them are 506Bs and can only take people they know or have a relationship with, the primary source of deal flow is networking with other investors. So you want to network and find syndicators and create a relationship with them so you can see their deals. And once you actually see their deals, you can actually invest in them. So we are also syndicators or general partners, or what we call the active investors in deals, right? So we do that as well. And we have an online newsletter and investor list, and I'll put that link below. It'll say invest with Ariane, so you can fill out that form and we'll connect with you later and develop that relationship. Now, we also personally invest as limited partners or passive investors in deals. And the way we've found operators we can trust is by going to different online and in-person networking events. These are usually related to real estate investing and multifamily investing. So once we go to those events, we meet people, we ask people for people they are investing with as far as syndicators and operators go. Then we meet up with those syndicators or operators or go to their website and we get their contact information. We sign up to their newsletters or investor lists. We talk to them, go to their hosted events, etc. So this is what we've done over the last 6 years, and we've seen all different types of syndicators and operators, right? We've seen people who promised the world and did not deliver, and those who did do what they said they would do, even through the tough times. So that was pretty cool to see that. And now, because we've been in this space for the last 6 years, we know who to invest with, that we trust, that will protect our money and make sure that they're getting the returns they are projecting. Now, if I was doing it all over again, I would do the exact same thing, right? What we did was we Googled multifamily investor meetups or multifamily investor events, and then you can see that all the events that you can find, right? Like usually you'll see some local. If you go to meetup.com and time that in, you can usually find some local investor events. So start there, get to know people, ask the people you network with if they've invested in syndications, and they can usually refer you to the people that they've invested with. Build your relationships from there. Now, we all live in a more virtual world right now, so you can also join real estate investor Facebook groups and ask for recommendations there. We have one called Faster Financial Freedom. I link to that Facebook group below, but if you join there, you can ask, hey, who are the syndicators you work with? And then people can give you referrals. Once you do find the syndicators, then you'll want to make sure that you're vetting them, right? Because remember, rule number 1 in investing, don't lose your money. So you want to make sure you're investing with people who are reputable. And if you got it from a referral, then hopefully they are reputable because the people have invested with them. But when you find those syndicators, you want to see their track record. What have they done for the last several years, and have they been successful? Right? Ideally, if it's your first time, I would suggest sticking to a syndicator who has done this for several years and has a track record of success. We've invested in syndicators with a shorter track record, but it's because we are active syndicators as well and we know what we're looking for in the deals. But if you're newer to this space, only invest with syndicators who've been around for at least 4, 5, 6 years, right? And there are some who have been around for decades. So ideally, you'll want to see that the syndicator hasn't lost any investor capital at all, ever, right? And they are on track on their current business plans. So if they own any properties right now, you want to see if they're on track paying their preferred returns and their milestones in their business plans. Not to say that there can't be any delays. Obviously, in the last 2 years, a lot has happened, right? Like a lot of black swan events have happened in the last 2 years. So sometimes there can be delays, but you want to see what they've done to mitigate those delays and to combat those delays. Now, you also want to check if they've had any capital events, like properties they've sold or properties they've refinanced. That's a good sign to see that they're able to do what they said they would do, right? Like if the business plan said they would sell in 5 years, well, did they sell in 5 years? And if not, what was the reason? If they said they would refinance in 3 years, did they refinance in 3 years? And if not, what was the reason, right? I'm not saying that nothing can deviate from the plan, because that does happen, but you want to see if they did deviate from the plan, what their explanation is for that, and what they did to correct that and combat that, right? So you just want to make sure that they're on top of their projects and they're not just buying deals to collect fees, because there are fees up front typically when you buy a multifamily syndications, right? Like the general partners usually get paid around a 2% acquisition fee, and that's because they usually spend months and months or even years finding the deals before it even gets to that point. So that's just a little compensation for them for all the work they did up front. But you don't want to invest with someone who's just buying deals and collecting acquisition fees and isn't managing the projects. That is the last thing you want to do. So we talked about how to vet sponsors and syndicators a little bit. Now, we talked earlier about getting referrals from other people, right? So when you do get a referral or you get a contact for a syndicator and you've done the first step, which is usually to sign up to their website or their investor list, the next step is to develop a relationship with them. Now, usually there's a 15-minute chat on the phone. That's part of the onboarding process when you hop on an investor list to get to know you a little bit. They usually have some events that you can go to, whether it's on Zoom, online, or in person, to help develop that relationship so you get to know them more, they get to know you more. Now, this is how you actually develop that relationship with them. And if you actually went to an event, then that counts, right? Like you met them in person, you had lunch with them, had dinner with them, something. After you create that relationship, then you'll see the offerings that they'll send over. Usually this is in the form of that investor email list you signed up to. You'll start receiving new offerings as they get them. One thing to remember is you don't have to invest in them right away. And I don't really recommend investing in the first thing you see, right? It's useful to start learning and getting used to the terminologies and what actually is involved in these deals, right? Ask as many questions as you need to understand the deal and see what you're getting into in terms of an investment. That's what the general partners are there to help you with. And maybe it takes you looking at 2, 3, 5, 10 deals before you feel comfortable, and that's totally fine. One thing to remember is not all deals will match your goals. In my other video about syndications, which you can watch here or go down below, we talked about different types of syndication deals, right? Some syndication deals have more cash flow involved, where in the beginning you might get 7, 8, 9, 10% cash flow right in year one. That's possible. So that's a cash flow type deal. Whereas there are some syndications that are more heavy lifts. They're more like renovation type deals where there's not a lot of cash flow in the first year or even 2, 3, 4 years, but there's more of a profit at year 5 when you sell the property, right? Now, some people might like the cash flow type deal. Some people might like those back end type deals. It depends on your goals. So you want to make sure you pick the investment that aligns with your goals. And once you find a syndicator you trust and a deal that aligns with your goals, then the next step is to read all the investor documents, you sign it, you send your wire in, and then you'll start receiving distributions, typically a quarter to 2 quarters later, depending on the type of deal, right? In cash flow type deals, you usually start receiving distributions 1 to 2 quarters later. In more the back end type deals where it's a heavy lift up front, then usually it can be 1 year, 2 years, 3 years before you start getting any distributions at all. So that's the general process we typically go through on how we find syndicators to invest in, and then how we vet them, and then how we actually invest with them. One thing I do want to mention is there are crowdfunding websites like crowdstreet.com, and they offer 50C type offerings where you don't need a relationship with them, and you could just go in there, look at the slide deck, watch their quick video, and then see if you want to invest. Their minimums are usually between 25K and 100K, which is similar to the 506B type deals. So you can try that. I've typically gone the route of wanting to know the people I work with because, you know, I'm just a little bit old school like that. I want to protect my investment by vetting the people that I work with. But I have heard other people have success with crowdstreet.com, so definitely check that out. One thing to note is usually those returns on the crowdfunding type websites are a little lower because the further you are from the source, right? Like there's CrowdStreet in between you and the actual provider, the more fees tend to dilute the returns. So just keep that in mind. We have more videos about syndication, so check out the syndication playlist. We'll put it up here and in the description below. And for people who want one-on-one consulting regarding advanced topics like syndications and funds, we have an application-only program called Wealth Accelerator for people who want to retire with investment income in 1 to 3 years. Now, this is a high caliber group. Usually you need a minimum threshold of net worth to get in there. So we don't accept anyone. The people we accept can benefit for sure, but the people we don't accept, we redirect them to a lot of our free resources. So go to wealthgym.com to see if you qualify for that, and I'll post a link below as well. And don't forget to join our free Facebook community called Faster Financial Freedom, where you can learn and network with others who also love talking about investing and creating financial freedom. I'll link to that below. Also, follow me on Instagram, the Ariane Lemire. I'll link below to that. I post more short form content over there about investing and financial freedom. And as always, guys, thank you so much for hanging out with me till the end of this video. Have an amazing week, and I will see you at the next video.